The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call. 800-306-1990, 800-306-1990. S&P 500 now down 21.6, moving a lot today. The 10-year Treasury is up 12 basis points. The mortgage-backed securities, they are down 58 basis points. Ow! That means interest rates are up. And every day at this week, talking about interest rates, interest rates, not weights. I've got the weight. No, not them. OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions. Yesterday, rates locked at 6.981 on the conforming. Jumbo 6.742, FHA 6.776, USDA, the rural loans, no down payment required in most cases, 6.801, and the 30-year VA loan, the loan on the market for those that earned it, 6.685. Now, because of the environment that we're in, most loans do have points on them right now, so that's just another issue going on. But here's the issue that I want to chat with you about, what's going on, why this is happening. Well, maybe there's an opportunity here. And generally, when there's blood in the streets, that means there's opportunity. So it is tough to see that the mortgage bonds are lower. 10-year Treasury setting a new recent high at 4.12. But there is light on the horizon. As I've shared with you many times, we believe towards the end of the year, next year, and into next year, inflation will begin to abate and mortgage rates will follow. One of the smartest minds in the world on economics, Lacey Hunt, he said he believes that the money supply beginning in March will fall to a more neutral level that removes all of the excess that was created over the past 2 years. If the Fed continues its path of tightening, he thinks that long yields will drop next year, which means 10-year Treasury and mortgage rates. Minneapolis Fed President Neil Kashkari said yesterday that the Fed may need to take the Fed funds rate above 4.75%. Now, they hike 75 basis points November 2nd, which everybody believes they will, and they do the same thing December 14th. Well, that'll put the Fed funds rate at 4.75. If Kashkari is right and needs to go above that, that's just signaling that maybe we'll see more tightening next year. Who knows? National Association of Home Builders Housing Market Index, which measures builder confidence, dropped significantly from 46 in September to 38 in October, the lowest since April 2020. 5 points below expectation, is now well below the 50 market, which is the neutral level. Anything above 50 signals expansion, below signals contractions. Looking at the internals, the present situation dropped 9 points to under the present situation dropped 9 points to under 50 at 45, while the future outlook component was down by 11 points to 35. Buyer traffic is now down to just 25 from 31 last year. NAHB said that higher rates have weakened demand, as we know, but they have also added that this will be the first year since 2011 that we'll see a decline in single-family starts. And I guess they're just kidding that we have more demand and that the supply is all there. Housing starts in September were down 8% to 1.439 million units annualized. Starts are down almost 8% year over year. Single-family starts, the most important ones, were down 5% last month at 892,000 unit pace. They are now down 19% year over year. So while interest rates are higher and demand is lower, supply should remain tight, as the NAHB mentioned. Housing permits, future supply, up 1.4% last month at 1.564 million unit pace, but are still down 3% year over year. Here's the big issue. It looks like the builders have learned the lessons of 2006 and 2007. Back then, they just kept on building. Now they've stopped their building. And when we know that we need 1.6 to 1.7 million units every year just for new households, household creation, you got to be careful there. Zillow, they've released their home price index for September, showing that home values have increased by 14.9% year over year. They believe that homes will appreciate 2% in the year going forward, which is still meaningful for wealth creation. They also reported that homes were only on the market for 16 days, matching the last existing home sales report and showing that if priced correctly, homes are still moving quickly. Bottom line with all of this, builders are not putting more properties out. There's creating 1.6 to 1.7 household formation. That means that when the interest rates start coming down, and they generally do during a recession at some point, well, sounds like it might be a good news for those who are thinking about buying a house or those that buy it right now. Now might be the best time. You buy a house right now and knowing that, maybe you're a little bit too early, but wouldn't you rather be too early than too late? Just throw that out there. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990.